Coming up in today's show, stocks rise on the back of more earnings beats, Apple falls again, SEC chief says AI will be at the center of the next financial crisis, and Warren Buffett's Berkshire Hathaway hits an all-time high. Welcome back to the Click Capital Daily Show, everybody. Hope you had a great weekend, and a bit of a bullish start to the week here, with a lot of breadth across the market. The only real standouts were Apple and Tesla down a bit today. Apart from that, pretty good moves up in all sectors, especially financials, with Berkshire Hathaway leading the way, which I'll get into a bit later. And so if you watched the show on Friday, you knew I did a deep dive into Apple and made a bit of a bearish case that it may be overvalued. We've been seeing declining revenue growth, and there's a bit of a technical damaging pattern on the charts as well formed. And it looks like we got a bit of continuation here today, down 1.7% on heavy volume again, 97 million shares traded, and we're already into short-term oversold levels, so we may get a little bit of a pause and bounce here. However, medium term, there has been some technical damage done to the chart now, and that tight parabolic uptrend it was in all year has clearly been broken. And currently sitting at an earnings yield of 3.1% isn't all that attractive versus the 5.34% you can get pretty much risk-free from the United States government by lending to them for 1 year. And compared to other solid companies out there like JP Morgan, which are still offering an earnings yield just shy of 10%, and that's with growing revenue as well. And one of the best performing stocks today was Warren Buffett's investment vehicle Berkshire Hathaway, up 3.6% today on a blowout quarterly earnings report, beating EPS estimates by 24%, surprising on the upside with revenue as well, and stocks closed at an all-time high. Another news out today, JP Morgan is the latest bank on Wall Street to push out its recession forecast of 2024. This comes a few days just after Bank of America did the same thing. And JP Morgan said waning post-pandemic disruptions and waxing supply side developments suggest upside risk. And it's true, the jobs market has been holding up pretty well all year, and if it continues to do so, then it's highly likely we won't get a recession before Christmas, which did look possible earlier in the year. However, there could still be storm clouds on the horizon. We got the SEC chief Gary Gensler saying that AI increases the risk of future financial crashes. He says a handful of dominant AI models will increase concentration, thereby raise the risk of a crisis. And just looking at the AI ETF bots, it's been one of the best performing sector ETFs year to date. We are currently in a short-term pullback here underneath the 50-day, and that's weakened somewhat compared to semiconductors, which are still holding up close to their all-time highs. We've also got Goldman Sachs saying a $2 trillion corporate debt wall will spark job losses next year. They estimate the economy could shed 5,000 jobs per month next year due to rising debt interest costs. That's because companies will need to devote a greater share of their revenue to cover higher interest expense as they refinance their debt at higher rates. And it's true, much of the economy, businesses and consumers have survived these higher rates and aggressive hiking cycle by the Fed because they've locked in a lot of their debt at the lower rates over the last couple of years. However, a significant portion of that debt's due for refinancing over the next couple of years. And I'd say that's also another reason why the Fed is very keen to get inflation down so they can comfortably call a top on rates and just bring that tail risk of very expensive refinancing down. Because if not, then guys like this may be right and we may see a black swan event from an epic debt bubble, and the higher rates go, the more stocks will be overvalued in comparison. He said, we're in the greatest credit bubble in human history. We're living in an age of leverage, age of credit, and it will have consequences. And this guy who runs a fund specializing in hedging against extreme and unpredictable tail risks is referring to ballooning amounts of household and federal debt. And like everything, there is some truth to it, and it's just a matter over the next couple of years whether economic growth can outpace inflation. Because like we already see in Europe, which is in a stagflation scenario, that does create further tail risks. And the US economy can escape it if it's able to grow faster than inflation, get those rates down, refinance again at good levels, and basically keep the party going. And if that happens, then this analyst could be right that the S&P 500 could triple to 14,000 by 2034 as a secular bull market cycle takes hold. He's saying the rally this year is part of a long-term secular trend for the US equity market as part of an underlying 16 to 18 year cycle, which he backed up with this chart here showing the S&P 500 has moved through periods of expansion and contraction every 16 to 18 years. Which, if true, which means we're currently a little bit past halfway in the current expansion cycle. Not much out in the way of economic data today, but we do have some good ones coming up later this week, with inflation data out of Germany and China tomorrow, and the big one is Thursday. with inflation data out from the States, and we'll be looking for the headline to come in at consensus 3.3% year-over-year growth, and core inflation stripping out food and energy 4.8% year-over-year growth. And that's going to be key input into what the Fed does next at their next meeting later on next month. But currently as it stands, the market's only given a 15% chance that they will hike next month, and a bit over 28% chance they'll do it on November. So the market's still not entirely sure, but the way they're pricing it, they're saying the Fed should be done. However, there still is a material chance that we get one more. And we're getting a bit conflicting views from some of the Fed presidents from around the country, with some saying 1 or 2 more hikes is needed, and others hinting that they may indeed be done for now. And like I said, it all hinges on this inflation report this Thursday, plus we'll get another one before the September meeting, and the jobs market as well will be key. And just looking at the bond market, with the Fed's sensitive 2-year yield is still hovering near highs, has pulled back a little bit the last couple of days to 477, and September Fed Fund futures still hanging around near their highs as well at 5.34, and December at 5.39. The fear and greed index ticking back up today to 72, wants to go back into the extreme greed zone. Bit of a sharp dip in the dark pool index here today, and continuing to diverge from the market, and still not much interest from corporate insiders in buying this market. Only 38 purchases recorded on Friday. And just looking at all the most important charts today, so the Dow Jones Industrial was the winner, up 1.1%, and microcaps actually finished off today down a little bit. Pretty flat performances from all the international stock indices out there, and volatility turned down pretty hard today as well. The VIX just above 15, a little bit of a bounce in short-term breadth, but still not close to breaking out on new highs. The growth versus defensive sector spread continues to hold up pretty well. However, we are getting a little bit of a downtick in the growth versus value stock spread, and there's inflation expectations ticking up to new multi-month highs again today. Got the dollar index pretty flat here at 1018. Got Bitcoin really consolidating here, just above 29,000 a coin. And it's been quite the pullback. I think we may come up and test this 31,000 again and possibly break through it to the upside, as BlackRock and others should get approved for the first spot Bitcoin ETFs, which will then create a lot of actual physical demand for the coin. Plus should be improved perception and crowd psychology for it as well. Commodities still holding up really well, and gold and crude pretty flat today. Over to stock sectors, mostly green out there. Biotech was the loser today, coming off 3.1% into technically oversold levels. And the winning sectors today were communications, financials, and aerospace and defense, still hovering near all-time highs. Still got a bit of weakness here on utilities, but they are sitting right at support where they've bounced before. Got a bit of a bullish divergence on our hidden divergence indicator, and currently in the oversold zone on our DSI, with a reversal signal in there as well. So this could be a good spot for a risk reward, with a tight stop loss and a bit of a reversion back to the mean play up to the 50-day VWAP. And just looking at popular stocks, we've got BlackRock sitting right at the 50-day. There's more technical damage done in Apple. Microsoft still on a short-term downtrend. Google holding up a lot better, getting close to year-to-date highs. Amazon defended its earnings gap from Friday and closed up a little bit today. And we've still got NVDA earnings coming, but that's still more than 2 weeks away on the 23rd of this month. There's Tesla continuing to look a little weak here in a short-term downtrend, and Meta holding up pretty good. Bit mixed in the meme space today. Bit of red, bit of green out there. And there's that big move up in Booking we got after their good earnings on Friday, which they delivered a 29% beat on EPS estimates. And travel stocks have been strong. We can see that with Royal Caribbean Cruises as well, holding up pretty good. And just shows the consumer is still out there and spending. And like I said, it doesn't appear that the higher rates are hurting as they normally would in past cycles, because a lot of businesses and consumers have locked in low fixed rates. The problem comes if those rates stay higher for longer. Even if the Fed is done and they just pause for a year or two, it's going to cause much higher refinancing costs, and that could spell trouble next year. However, if inflation does continue to tick down, the jobs market holds up, and we continue to see economic growth, then it's also possible the United States economy may have a lucky escape out of that. So it'll be all eyes this Thursday on the inflation data that comes through. Until then, over the next few days, I'd expect the market just to trade pretty quiet in low ranges and low volume, probably around the 4,500 level on the SP 500. Then we should get the move come Thursday. And that's all today to start the week. Thanks very much for coming back to Click Capital, and I'll see you guys again tomorrow afternoon. Cheers.